Alright, hey guys, Scott here again with my next live trading video, and this one will be a bit unusual for my channel, right? Because we're going to focus on, in my view, the best way to buy options. And in particular for this video, we'll focus on the put debit spread strategy. That's, in my opinion, the best way to buy options in general, and you'll see why later in a minute. And of course, this is unusual for my channel, right? Because most of my content is centered around options selling strategies. And so there is a whole host of reasons why also, in my opinion, option selling strategies are better than option buying strategies in most situations. But that being said, there are a few specific circumstances, as you'll see in this video, where buying options, specifically using a put debit spread strategy, can be very, very advantageous. Now, briefly here before we dive in, if you guys want to receive up to 13 free stocks in a very cool limited time opportunity, then make sure you watch until the end of the video. And also here, for anyone who would like to join a very exclusive online community where you can learn how to successfully trade options and learn my custom approach to the markets, then you can now join my options trading Discord. So definitely make sure to check out the description of this video below to learn a lot more about that. And then finally here, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you join Skillshare using those links, you'll get a full 1 month free trial. Alright guys, so now diving in here, and for this video, we're going to focus on a new trade I made this morning here in Apple. And so first up here, let me show you why I even considered buying options at all on this stock compared to what I usually do, which is selling options. Right, so if we come down here and take a look at this chart, this is showing you the implied volatility for Apple over the past 1 year. Now, real quick, in case you're not aware of what implied volatility is, it's basically just a measurement of uncertainty about the future for a particular stock, in this case, Apple. And most importantly, the implied volatility is used in part to price option contracts. And specifically, as the implied volatility expands, or basically as there's more and more uncertainty about Apple's future, then option prices for Apple will steadily increase in price. And then conversely, as implied volatility comes back down, or as it contracts, then the option prices will come down along with it. And so now back to the implied volatility graph here. As you can see right now, the current value for implied volatility of Apple is only 27%, which just visually looking at this chart here is much, much lower than where it has been over the past 1 year. Right? The vast majority of the days, the implied volatility for Apple has been much higher, and reaching as high as around 47% and as low as around 24 or 25%, which is not that much lower than where it is right now. And so like I just explained, this means that right now the options for Apple are very, very cheap compared to where they usually are. Right? Because one more important concept about implied volatility is that it's usually mean reverting, which means it likes to fluctuate around a long-term average. Right? So unlike a stock price, you will not see implied volatility steadily increasing over time or steadily decreasing over time. Instead, it's very cyclical in nature, so sometimes you'll see large spikes and sometimes it will contract significantly, but every time the implied volatility gets too extended in one direction or the other, it always comes back around to roughly the long-term average, which in the case for Apple here is probably around 35% or so, kind of right in the middle. And so bottom line, with the implied volatility right now for Apple being so low, this would be a good potential opportunity to buy the contracts, right? Because whenever you buy any kind of asset, you want to buy that asset when the price is very, very cheap. And also, given that implied volatility is mean reverting, there's a pretty good chance at some point in the near future, we're going to see the implied volatility for Apple expand once again. And that's going to increase the prices of those options. And so, of course, that's exactly what you want to happen whenever you buy options. You want the price to increase over time. Now, also take note here, looking at the price action chart, the relationship between how the stock moves and how the implied volatility moves. Right? So specifically, whenever stocks enter a large uptrend like this, you are basically guaranteed to see the implied volatility contract down to very low levels. Right? Because again, implied volatility is a measurement of uncertainty or fear about the future. And most people in the stock market are only fearful when stocks go down, not up. Right? So basically there's an inverse relationship between stock price fluctuations and implied volatility. When stocks go up, implied volatility usually goes down, and then vice versa, right? So for example, back in here, when Apple stock was crashing, look at the implied volatility. It was rapidly expanding. And so this here is exactly why, in my view, using a put-based option buying strategy like a put-debit spread is the best way to go about buying options in general, right? Because whenever you do buy options, you pretty much have to be directionally correct on the trade. So with put options, when you buy them, you want the stock price to go lower, but if that happens, you also get the extra advantage of a likely expansion of implied volatility. Whereas compared to buying call options, and in that case, you want the stock price to increase in price, but if that happens, then implied volatility will likely contract, and that's going to work against your position, right? So if the stock price does increase, that's also going to increase the price of your call option. That's a good thing. But when the implied volatility contracts, that's going to try and reduce the price of your call options. So those two things are going to fight each other essentially. And depending on which one has the greater effect, you may actually still make money on the trade or perhaps even lose money. But then, of course, also don't forget that time decay does always work against you as an option buyer. So that's also why, as you'll see here in a minute, why I prefer to use debit spreads to buy options as opposed to just buying a call or a put by itself. And so ultimately here, with the implied volatility for Apple being so low right now, and also with the price action chart just screaming bearish, right? So for example, Apple right now has just reached a long-term trend line, which I definitely think will act as a resistance point, and especially also look what this stock has done in the recent 2 months here. Apple has done nothing but go straight up. And this is definitely very rare behavior of any stock, right? Because even in a major uptrend, you oftentimes see the stock have a lot of chop along the way, right? So basically, as you can see over here, oftentimes you'll see a large up move and then a pullback, an up move, pullback, again and again. And even though technically speaking, there has been a few very, very small little pullbacks here in this massive uptrend, overall, I do think Apple is very overextended to the upside. And one last thing, if we come down here and take a look at the RSI indicator for Apple, and this one here tells you how overbought or oversold a stock might be. And basically, if this indicator gets over a value of 70, which right now it definitely is at 75, this stock is definitely for the time being overbought and very much overdue for a correction. And so ultimately, that's why this entire setup here seemed advantageous enough for me to buy options, right? Because normally with a bearish setup like this, my default trade would be to sell out of the money call options. But again, with the implied volatility being so low right now, selling options in general on Apple right now is not a good move. And so with that being said, now we'll come over to the trade tab here and I'll show you the exact trade I made on Apple. And so as you can see right here with these small position flags, I'm in the September 16th monthly expiration with 30 days left to go. We'll unfold this tab here and scroll down a little bit. So right here, as you can see, is my trade. I bought the 175 strike put option and then sold the 165 strike put option. So this here is basically a $10 wide put debit spread. And so now here, there's a few reasons why I made this exact kind of trade. So in particular, let me go ahead and create a brand new buying order so you can see a few of the details around this trade. So I'll go to buy and vertical. And here we go. This is the exact order I made this morning. Bought one contract, 175 strike put option, sold one contract, 165 put option, and did so for a debit of exactly $320. So basically, so far this position has hardly changed in price at all. And so with the debit here being about $320 and the max profit on this trade being about 700, right? So for example, if I go to confirm and send real quick, you can see right there the max profit is $677, almost 700. And so when it comes to buying debit spreads, this is typically the risk reward ratio that I look for, right? So I'm risking 324 with the debit paid to make a possible max profit of 677. So essentially I'm risking 1 to make a max of 2. And so the reason why I like this kind of ratio for debit spreads is because the max profit here is very satisfactory compared to the capital I'm risking. And then also this spread here has a pretty high chance of paying off, right? So whenever you buy debit spreads that are basically right at the money, there's about a 50-50 shot of making a profit. Now, of course, also if you do want a higher chance of profit, then you can buy your spread more in the money. But then also the trade-off with doing that is your max possible profit will be smaller. So bottom line here, whether you want to go in the money or basically right at the money, that's fine. But I definitely would not recommend going out of the money and buying these options. Of course, if you do, the debit paid will be very small and the max profit could be huge, but then obviously your chance of profit is going to be almost zero, right? So basically, unless you want to just gamble, then again, in my view, it's much better to trade debit spreads in this zone right here. And then lastly here, there are two reasons why I made this spread 10 bucks wide. Number one, and most importantly, I wanted to keep my risk on this trade pretty darn small. So again here, I bought this spread for a debit of 320 bucks, which is a bit less than 1% of my total capital in this account. And generally speaking, my rule of thumb is to not risk more than 5% of my total account value on one trade. So of course, I could have gone much bigger with this trade, but again, with this being an option buying strategy and with it having basically a 50-50 chance of paying off, I wanted to keep my risk on this trade extra small. And then the second reason why I made the spread 10 bucks wide is because I wanted to counteract the time decay on this position, right? So as I mentioned earlier, when you buy options, time decay works against you, but with a debit spread, the short contract can almost entirely cancel out that time decay, right? So for example, here with my long contract, the theta value on this option is -7. So basically this means every day that passes, all else being equal, this option will lose value by about 7 bucks per day. And because I bought this contract, right, that's a bad thing. However, take note of the theta value on my short contract. It's also -7. So for the time being at least, every 7 bucks I lose on the long contract, I will make back on the short contract. So bottom line, the net effect is that my position here does not have any kind of time decay for the moment. Now also the downside of this though is that the delta on my short contract as well as the vega on the contract will offset those same Greek values on the long contract, at least partially. So as you can see, the delta on the long put is 53, the delta on the short put is 25, so the net delta on this entire spread here is 53 minus 25, that gives me 18. And same thing with vega. The vega on the long contract is 20, the vega on the short contract is 16, so my net vega exposure on the spread is 20 minus 16, which is only 4. But still, because I do have some delta exposure and some vega exposure, then I still will take advantage and profit from a down move in Apple's price as well as an expansion of its implied volatility. And if it takes some time for those two things to happen, then no big deal. Like I said, right now, there's almost no time decay at all on this position. And then finally here, in regards to profit taking and just overall management of this position, I definitely could wait all the way to the expiration date and potentially make the max profit, but I prefer to take profits a bit earlier, right? Because it's basically only possible to make the max profit if you hold this trade all the way to expiration and the spread here is entirely in the money by expiration. And obviously having to wait 30 days for that to possibly happen, that's a long time for the stock to move against me, especially if maybe tomorrow or next week, Apple does have a nice down move and some IV expansion, and my profits on this trade are already pretty satisfactory. So therefore, what I'm going to do here is create an automatic closing order to take my profits at a specific profit target. And so to do that, I'll delete this order right here, and then right click on the long put option here, and go to sell vertical. And here we go. This is going to be the closing order to sell my long contract with the 175 strike and then to buy back my short contract with the 165 strike. And my initial profit target will be to sell this spread if the price increases by 100%. So again, if I bought this spread for a debit of 320, then that means I'll want to sell it if the price basically doubles and goes to 640. And then lastly, I'll make this a GTC order so it's always in place and confirm and send and send. And so there you go. That's, in my view, the best way to go about buying options, specifically using a put debit spread strategy. So hopefully this video here gave you some good insight and some good tips and tricks that you can apply in your own trading. And so with that being said here, that's going to do it for this video. But one last thing, as I mentioned, I've got a very cool opportunity for you guys where you can receive up to 13 free stocks. So basically there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 13 free stocks when you open a brokerage account with them using my specific link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.